Swing Trading, Chapter 15, The Trader's Routine and Psychology. Before the market opens, you have something very valuable that disappears once the bell rings. Time to think clearly. The first minutes of the session can be fast, noisy, and emotional, which makes it easy to confuse movement with opportunity. Pre-market preparation is not about guessing exactly what will happen after the open. It is about deciding in advance what you will watch, what levels matter, and what kind of trade would actually fit your plan. That preparation reduces rushed decisions because you are no longer trying to build a trade idea in the middle of volatility. Traders who skip this step often end up chasing price, while prepared traders are more likely to wait for their setup. Scanning is meant to reduce complexity, not create more of it. The market gives you hundreds or even thousands of symbols, but only a small number will match your strategy on any given day. A good scan helps you narrow that large universe into a short list that deserves deeper review. That means you are not trying to catch every move or find the single best stock in the entire market. You are simply identifying a few quality candidates that fit your rules well enough to study before the open. A manageable watch list is far more useful than a long list that scatters your attention. A useful scan usually combines several pieces of information instead of relying on just one. Unusual volume can tell you a stock is active, price near key levels can tell you where a decision point may be forming, and a catalyst can explain why traders are paying attention in the first place. Clear price structure matters too, because even a busy stock is difficult to trade if the chart is messy and directionless. Think of scanning as filtering for activity, location, and context all at once. For example, a stock trading near resistance with stronger than normal volume after meaningful news is more interesting than a random stock that is merely moving around. The goal is not excitement, but a setup that makes sense on the chart. Relative volume gives you context by comparing today's trading activity with what is normal for that same time period. That matters because 10,000 shares traded at 8:45 in the morning can mean something very different depending on the stock. If a name is trading at 2 or 3 times its usual pre-market volume, that tells you attention is unusually high and the stock may be worth a closer look. But relative volume is only an invitation to review, not a trade signal by itself. A highly active stock can still have poor structure, unclear levels, or no setup that fits your rules. In practice, volume tells you where to look, while the chart and your plan tell you whether to act. Before you judge individual stocks, it helps to understand the broader market tone. Index futures, major overnight headlines, and any important macro news can shape how aggressively traders behave at the open. A strong market backdrop can support long setups, while a weak or uncertain backdrop can make even good-looking charts less reliable in the early minutes. This does not mean every stock will move with the indexes, but it does mean your setups do not exist in isolation. If futures are sharply lower and fear is rising, you may need to be more selective or more patient. Context helps you set realistic expectations before you ever focus on a single ticker. The best pre-market routine is usually simple enough to repeat every day. You can set your filters ahead of time, run the scan about 30 to 60 minutes before the open, and then review only the top handful of names. Keeping it to 5 or 10 candidates forces you to prioritize quality over quantity. This also gives you a consistent process, which makes it easier to learn what your scan actually produces over time. If you keep changing filters every day, you never really know whether the method works. Small refinements are useful, but they should come slowly, based on evidence rather than frustration. Once the scan gives you candidates, review each one the same way every time. Open a short-term chart, check whether the pattern is clear, compare volume with what is normal, and confirm the important price levels and any catalyst behind the move. That consistent review process keeps your watch list comparable, because each stock is being judged by the same standard. It also makes it easier to avoid being seduced by one dramatic chart that does not really fit your strategy. For example, if a stock has heavy volume but no clean structure, it may still fail your review. Consistency in evaluation is what turns a scan into a disciplined watch list. After you identify your strongest candidates, the job changes from searching to planning. Keep the watch list small, ideally 3 to 5 names, so you can focus deeply instead of spreading attention across too many charts. Mark the levels that matter before the open, where you would enter, where you would place the stop, where a target might be, and where support or resistance could change the trade. This step turns vague interest into a concrete plan. It also helps to stop scanning about 10 minutes before the bell so you can settle in and review, rather than keep hunting for new ideas. Last-minute searching often creates distraction, not better decisions. A stock becomes a real watchlist candidate when several factors line up together. Imagine ABC is trading with 3 times normal pre-market volume, consolidating in a tight range between $45.40 and $45.60, and there is a clear product trial news catalyst behind the move. That combination gives you activity, structure, and a reason for attention. From there, the trade plan becomes specific. If price moves above $45.60, you may consider an entry, with a target near $46.50 and a stop around $45.10. Notice how the plan comes from the chart and the context, not from hope. This is what it means to turn a scan into a trade idea you can actually manage. Many pre-market mistakes come from trying to do too much, too late. Scanning too close to the open leaves no room for calm review, and watching too many stocks makes it hard to know what really matters. Ignoring the broader market can also distort your judgment, because an individual setup may look different once you place it in context. Another common problem is changing filters constantly, which usually reflects impatience rather than improvement. And one of the worst habits is trading while you are still scanning, because that means you are mixing research and execution under pressure. Good preparation is defined as much by restraint as by activity. A very effective way to build this skill is to practice the routine without placing trades. Run a simple pre-market scanner at least 30 minutes before the open, review the top 5 charts on a 5-minute view, and write down what you notice about volume, pattern, key levels, and possible catalysts. This gives you repetition without financial pressure, which is where real learning happens. Over time, you will start to see which names truly fit your strategy and which only looked exciting in the moment. You are training your eye and your judgment before money is involved. That makes the eventual shift to live decision-making much more grounded and much less reactive. Once the market opens, your job changes. The planning work is mostly done, and the focus becomes execution and management rather than constant idea generation. Good traders stay attentive, but they do not react to every flicker on the screen. Most price movement is noise, and treating all of it as meaningful usually leads to overtrading or unnecessary stress. Your role is to notice meaningful changes, compare them with your original plan, and respond only when the trade truly requires action. Calm attention is far more useful than non-stop activity. It helps to separate monitoring from managing because they are not the same thing. Monitoring means observing price, volume, alerts, and market context without automatically changing anything. Managing means making a deliberate adjustment, such as exiting, tightening a stop, or taking partial profits. Beginners often blur the two and feel that every movement demands a decision. In reality, the default action is often to wait. If the trade is still behaving according to plan, observation is enough, and restraint becomes part of good management. A simple routine during market hours can protect you from emotional drift. Start by reviewing the original trade plan so the key levels and the reason for the trade remain fresh in your mind. Use alerts whenever possible so you do not feel forced to stare at every tick. Keep your attention on the setups you planned instead of wandering into random stocks that happen to be moving. If you adjust levels, do it only for a clear, rule-based reason, not because a candle made you nervous. These habits sound basic, but they are what keep a trading session calm and structured. Consistency improves when you use the same trade management sequence every session. Open your platform alongside your pre-market notes so your decisions stay connected to the original plan. Confirm your current positions, your stop levels, and your targets before the action picks up. Set alerts at the prices that matter so the market does not have to occupy all of your attention every second. Then keep asking one simple question. Is this trade still in plan? That question turns management into a process of verification rather than emotional improvisation. When an alert triggers, the goal is not to react quickly but to think clearly. A short checklist can help. Is price still behaving according to the setup? Has the trade moved enough to justify protecting profits? Or has the original idea failed? If the setup still looks intact, holding is often the correct choice. If the move has gone in your favor, you may adjust by tightening the stop or taking partial profits. If the stop is hit, or the reason for the trade is clearly gone, then closing the trade is the disciplined response. The checklist creates space between the alert and the action. Managing winners well means reducing risk without letting greed or hope take control. As price moves toward your target, you might scale out of part of the position to lock in gains. If the trade has moved favorably enough, tightening the stop on the remaining shares can protect some of that progress. This allows you to stay in the trade while lowering the damage if it reverses. What should never happen is widening the stop simply to avoid taking a loss. A stop is part of the original risk plan, and moving it farther away out of hope usually turns a manageable loss into a larger one. A trade can begin drifting off plan even before the exact stop loss is touched. Maybe the price action no longer matches the setup you entered, or volume starts confirming weakness instead of strength. Sometimes the broader market changes, or a piece of news alters the context that supported the trade. In those moments, the right response is a serious reassessment, not blind loyalty to the original idea. If the reason for the trade is no longer there, it may deserve an exit even if the official stop has not yet been hit. Discipline is not stubbornness. It is honest review. Consider a simple example of disciplined management. You buy 500 shares at $20 with a stop at $19.70 and a target at $20.80. When the stock reaches $20.50, you sell 250 shares to realize part of the gain. Then you tighten the stop on the remaining shares to $20.20, which protects some profit while leaving room for the trade to continue. Even if the second half does not reach the target, this is still strong trade management because risk is being reduced in a planned way. In the example, the second half of the trade did not exit exactly where the stop was set. Price reversed quickly after reaching $20.50, and although the stop was at $20.20, the actual fill came at $19.95. That difference is called slippage, and it is a normal part of real-world execution. It reminds us that the market does not always give perfect exits, especially during fast movement. Even so, the overall trade still produced a net gain of $112.50 before fees, because partial profits had already been locked in. The lesson is that good process matters more than perfect precision. The skill to build here is structured management under pressure. A good exercise is to practice with one planned trade in a demo account and log each check-in during the session. Write down whether the trade was still in plan, whether you followed your rules, and whether any action you took was justified by the setup. Keep the exercise focused by avoiding extra trades during the practice period. That is important because distractions make it harder to see your real habits. This kind of repetition reveals whether you are managing trades intentionally or just reacting to noise. After the market closes, the learning opportunity is still very fresh. A short daily review helps turn the day's trades into useful feedback instead of letting the experience fade into memory. This is where repeat mistakes begin to stand out, especially the ones that seem small in the moment but keep showing up over time. A journal gives you a place to record what you did, why you did it, and how you felt while doing it. That emotional context matters because trading decisions are rarely as mechanical as they look afterward. Even 5 to 15 minutes of honest review can create a much stronger starting point for tomorrow. One of the most important habits in review is judging a trade by process, not by profit. A trade can lose money even when it follows the setup, the sizing rules, and the risk plan perfectly. It can also make money even when it breaks several rules and only works because the market happened to cooperate. If you grade trades only by outcome, you reward luck and misunderstand your own behavior. A well-executed losing trade may deserve an A, while a profitable rule breaker may deserve a poor grade. This mindset is essential if you want to improve something real, rather than just react to the latest result. A useful journal captures both trade facts and emotional context. On the factual side, record the asset, the date and time, the entry and exit prices, the position size, and the final profit or loss. Just as important, write the reason for the entry and the reason for the exit, because those explanations reveal whether the trade truly matched your strategy. Then include what you felt before the trade, during the trade, and after the trade closed. Maybe you felt confident before entry, anxious during a pullback, and relieved after exiting. Those emotional notes often explain behavior that the price data alone cannot. Emotions belong in the journal because they often shape behavior before you fully notice it. Boredom can push you into unnecessary trades, fear can tempt you to widen stops or exit too early, and frustration after a loss can lead to chasing or revenge trading. These patterns are hard to see clearly in real time because they feel justified in the moment. Writing them down creates distance and makes them visible. After several days or weeks, the journal may show that your biggest losses are not coming from bad setups at all, but from repeated emotional responses. Once a pattern is visible, it becomes much easier to correct. An end-of-day routine works best when it is short, structured, and repeatable. Wait until all trades are closed so your judgment is not mixed with open position stress. Then list each trade and its result, write down the setup or trigger that led to the trade, and note your emotions at entry, during the trade, and at exit. After that, give the process a grade and finish with one practical lesson from the day. That final lesson should be specific enough to apply next time, such as waiting for confirmation or avoiding trades after frustration. The goal is not to create a perfect diary, but a habit that you can sustain. A clear grading scale keeps the review honest. You might use an A for a trade that followed the plan completely, a B for a mostly solid trade with a minor mistake, a C for a trade with significant discipline problems, and a D for a trade that broke the rules completely. The key is that the grade reflects execution quality, not the amount of money made or lost. This gives you a simple language for evaluating your behavior from day to day. Over time, you can begin to notice whether poor results come from weak setups, emotional mistakes, or just normal market variance. A simple scale makes those distinctions easier to track. A journal often uncovers connections between trades that are easy to miss during the session. One trade may be completely planned and disciplined, yet the loss from it can affect the next decision in a harmful way. A later trade might come from hope, frustration, or an urge to recover rather than from a valid signal. In that case, the real problem is not the first losing trade. The real problem is the emotional spillover into the next one. This is why daily review should look across the sequence of the day, not just at each trade in isolation. Journaling only works if it stays honest, timely, and simple enough to maintain. Recording only winning trades creates a false picture of your behavior, and waiting too long to review lets important details fade. Writing too much can also become a problem, because a journal that feels heavy is harder to keep consistently. Vague notes like "looked strong" are much less helpful than naming the actual setup and the reason for entry. Another common mistake is grading by profit instead of process, which weakens the whole exercise. A useful journal should help you tell the truth clearly, not impress anyone. The best journaling format is the one you will actually keep using. It can be a notebook, a spreadsheet, or even a phone note, as long as it captures the same basic information consistently. A practical way to begin is to review your most recent trade and write the facts, your reason for entry, your feelings before, during, and after, and a simple process grade. Then end with one sentence you can use next time, such as "wait for volume confirmation before entering." That final sentence turns review into action. Consistency matters much more than having a polished system. A daily review helps you stay aware, but a weekly review gives you enough distance to judge your trading more fairly. One day can be heavily influenced by luck, unusual volatility, or a small sample of trades. Over a full week, repeated behaviors become easier to see. You may notice that certain mistakes happen only on slow days, or that impatience tends to appear after early losses. This broader view also reduces the temptation to overreact to one strong day or one bad day. The weekly review is where short-term noise starts turning into usable evidence. The first question in a weekly review should be about process, not profit. A profitable week can still hide poor execution if some of the gains came from oversized risk or broken rules. In the same way, a losing week may still reflect solid discipline if the trades followed the plan and the market simply did not reward them. This is why entry quality, exit discipline, and risk control deserve more attention than the final dollar amount. Profit is useful information, but it is a secondary measure. If process is weak, profit can be misleading. A strong weekly review revolves around a small set of honest questions. Did you follow your rules consistently, or only when conditions felt comfortable? Were the setups truly there, or did you force trades because you wanted action? Did your strategy fit the market environment that week, such as trend, range, or volatility conditions? And were the mistakes isolated incidents or part of a repeated pattern? These questions move the review beyond simple performance numbers and toward understanding. They help you identify whether the problem was the market, the strategy, or your execution. Before you draw any conclusions, start with clean data. Use only closed trades so your review is based on completed outcomes rather than on open positions that could still change. Record the entries, exits, position sizes, stops, and targets for each trade. Then bring in your journal notes, including emotional observations, because the numbers alone rarely explain the full story. This creates a complete picture of what happened during the week. Good review starts with accurate facts, not impressions. Basic numbers help summarize the week, even though they do not tell the whole story. Useful measures include the total number of closed trades, the win rate, the average win, the average won, the average loss, and the net profit or loss. These metrics can quickly show whether your reward to risk profile is healthy or whether frequent small wins are being erased by larger losses. But numbers should support the review, not replace it. A weak process can hide inside decent statistics, and a solid process can sit inside a flat week. Metrics are the starting point for questions, not the final answer. Once the data is organized, look for repeated patterns rather than isolated events. Maybe one setup is consistently underperforming, or maybe your entries are often late because you hesitate and then chase. You may find that your stops are too tight for the volatility of the names you trade, or that emotional decisions tend to appear at key moments like after a loss or near a target. Patterns matter because they point to issues that can actually be improved. A one-off mistake may not need a major response. A repeated mistake usually does. A useful weekly review should end with one focused adjustment for the next week. Choose a single issue that matters. Make the change specific and make it easy to observe. For example, instead of telling yourself to be more disciplined, you might decide not to take trades in the first 10 minutes, or to require a minimum reward to risk ratio before entering. Small, measurable changes are easier to test honestly. Large emotional overhauls usually create confusion because too many variables change at once. Improvement tends to come from steady refinement, not dramatic resets. Emotions deserve their own place in the weekly review because they often explain the mistakes that numbers cannot. Fear, boredom, greed, frustration, and overconfidence can each leave a different fingerprint on your trades. You might notice that boredom leads to low-quality entries on quiet afternoons, or that frustration shows up after 2 losses in a row. The important step is linking those emotions to actual decisions, such as oversizing, chasing, or skipping valid setups. Once you can see the connection, you can build rules to interrupt it. Emotional review is not separate from performance review. It is part of it. Imagine Carlos ends the week with 12 closed trades and a net profit of $320. At first glance, that sounds like a successful week. But a closer look shows that some losses were perfectly valid trades that followed his rules, while some wins came from broken rules and impulsive decisions. The review also reveals repeated impatience and weak discipline. In that case, the profit overstated the quality of execution. This is exactly why weekly review has to look beneath the surface of the P&L. Carlos responded well because he made focused process changes instead of reacting emotionally to the review. He decided to require all 3 of his confirmation signals before entering, to use automated profit targets to reduce impulse decisions, and to step away when boredom appeared. Just as importantly, he treated the review as guidance rather than as a personal judgment. That mindset matters because shame tends to make traders defensive, while curiosity makes them adaptable. The purpose of review is not to prove that you are good or bad. It is to help you trade better next week. Weekly reviews become much more useful when you avoid a few common mistakes. Focusing only on profit or loss can hide important execution problems. Changing too much at once makes it difficult to tell which adjustment helped and which one hurt. Ignoring rule-breaking wins is another trap, because profitable mistakes can quietly become repeated habits, and overreacting to a single week can lead to unnecessary strategy changes. Strong reviews stay process-focused, evidence-based, and patient enough to learn from patterns over time. Swing trading is not only a test of analysis, it is also a test of how well you can think when money, uncertainty, and emotion are involved. Fear, greed, and revenge trading are common because they come from normal human reactions. The problem is that markets reward disciplined process much more than emotional impulse. These biases can pull you away from the rules you created when you are calm and clear. Once emotion starts leading the decision, the quality of execution usually drops quickly. Fear often looks less dramatic than people expect. It may appear as hesitation before a valid entry, or as an early exit long before the stop is reached. In both cases, the focus shifts from following the setup to escaping the discomfort of uncertainty. The trader is no longer managing risk according to plan, but trying to feel relief as quickly as possible. That can lead to missed opportunities, uneven execution, and a habit of abandoning good trades too early. Fear is not the same as caution, because caution still follows the rules. Greed often arrives after success, which is why it can be hard to recognize. A trader may feel confident after a string of wins, but that confidence slowly turns into changing the rules in search of more profit. Maybe the position size grows beyond normal risk, or the trade is held well past the planned target without a valid reason. Sometimes the rules are even rewritten in the middle of the trade. The key distinction is that disciplined confidence follows the plan, while greed tries to improve the plan on the fly because things have been going well. Success can be just as dangerous as failure if it weakens discipline. Revenge trading is driven by frustration after a loss. The hidden goal becomes getting the money back quickly or undoing the emotional discomfort of being wrong. That shift creates urgency, and urgency often leads to impulsive entries, oversized positions, and repeated poor trades. In other words, the trader stops asking, "Is this a valid setup?" and starts asking, "How fast can I recover?" That question almost never leads anywhere good. Trying to fix the last loss emotionally usually compounds it. These emotional biases often follow a predictable cycle. A stressful market moment appears, emotion rises quickly, and rules begin to loosen in the name of relief or opportunity. The trade may then work or fail, but either way the emotional decision leaves a mark. If it fails, regret builds and makes the next decision harder. If it works, the trader may wrongly trust the emotional behavior and repeat it. That is how a temporary lapse can turn into a pattern. The cycle gets stronger when it goes unnoticed. Rule breaking usually has a simple form. Even when the emotional reason behind it changes, you might exit before the plan stops because fear wants relief. You might hold well beyond the target because greed wants more. You might increase size without any rules supporting it, or enter without a valid setup because urgency has taken over. In every case, the common thread is departure from the original plan. That is why trades should be judged by whether the plan was followed, not by whether the outcome happened to be profitable. Priya's experience shows how different emotions can produce the same underlying problem. In one trade, fear led her to sell at 985 even though her stop was lower, which meant she exited for comfort rather than according to plan. After several wins, greed showed up when she doubled her size without a rule to justify it. Then, after a loss, revenge pulled her into an impulsive new trade. These are three different emotional states, but they all led to the same outcome. Her process was overridden. That is why emotional control is less about naming feelings perfectly and more about protecting the plan. Emotional mistakes usually begin with small warning signs, not dramatic decisions. You may notice physical tension, irritation, a sense of urgency, or thoughts like, "just this once." Sometimes the strongest signal is an urge to recover quickly after a setback. These moments matter because they appear before the actual rule break. If you catch them early, you have a chance to pause, step away briefly, or review your plan before acting. The earlier you notice emotion building, the more control you still have. Clear definitions make these biases easier to manage. Caution follows rules, while fear abandons them. Confidence stays disciplined, while greed adds risk and changes the plan. Recovery is patient and measured, while revenge is urgent and emotional. These distinctions matter because traders often excuse bad behavior by giving it a better-sounding label. The market is not usually the true cause of the rule break. The same market can produce very different decisions depending on the trader's state of mind. A simple review habit can help separate emotional impulse from rule-based execution. After each trade or at the end of the day, look back at your last 3 trades and write what you felt before entry and before exit. Ask honestly whether fear, greed, or revenge was present anywhere in the decision process. Then compare that emotional response with what your plan actually called for. Finish by writing the better action in plain language. This keeps the review practical and specific instead of turning it into self-criticism. A routine matters because it gives structure to moments when pressure would otherwise take over. Without a routine, you are forced to make many small decisions throughout the day, and that creates decision fatigue. As mental energy fades, impulsive and emotional choices become more likely. A good routine reduces that burden by turning useful behaviors into habits. It supports calmer execution because you are not inventing your process in real time. Over the long run, this is one of the clearest ways to make trading more sustainable. Under stress, traders usually fall back to whatever their default behavior is. If there is no routine, that default may be hesitation, overreaction, or abandoning the original plan. A routine gives you a pre-planned response instead. You can check your daily risk limit, confirm stop-loss levels, follow planned exits, and avoid unnecessary changes even when the market is moving quickly. Those actions act like guardrails when emotions rise. The goal is not to eliminate stress, but to keep stress from rewriting your decisions. Routine is useful even when the market is quiet. Slow sessions often create boredom, and boredom can be just as dangerous as volatility because it tempts traders into low-quality setups. A solid routine keeps you productive without forcing action. You can scan only for valid setups, review recent journal entries, update levels, or simply stand aside if nothing meets your criteria. That is real discipline. Sometimes the best routine in a quiet market is to do less and protect your capital from unnecessary trades. A practical routine should focus on actions that actually improve decisions, execution, and risk control. Useful steps might include marking key levels, checking position size, and reviewing your open risk before the session begins. Those actions directly affect trade quality. Familiar rituals, on the other hand, may feel comforting without helping performance at all. There is nothing wrong with having personal habits, but they should not be confused with trading preparation. If a step does not improve your process, it may not belong in the routine. A strong routine becomes easier to sustain when it is built around a few non-negotiable actions. You might briefly review yesterday's trades, check overnight news headlines, set a daily risk limit, and mark key levels before trading begins. Putting those into clear time blocks helps them happen consistently, even on busy days. This is important because the best routines are not the most ambitious ones. They are the ones that still get done. A small set of reliable anchors creates far more stability than a long list that collapses after 2 days. Time blocks and a shutdown ritual help keep trading from spilling into every open moment of your day. You can define separate periods for preparation, active trading, and review, rather than checking prices constantly from morning to night. That structure improves focus because each part of the process has a job. At the end of the day, closing the platform, turning off notifications, and stepping away creates a mental reset. It also reduces the chance of impulsive re-entry after the session should be over. Clear stopping points are part of discipline too. One of the most valuable habits in any routine is reviewing adherence rather than profit alone. A good trade can lose money, and a bad trade can make money. So outcome by itself is not a reliable guide. Instead, check whether you followed your plan, used correct sizing, entered where the setup called for, and exited according to rule. A journal is useful here because it records what actually happened instead of what you later remember. This kind of review protects discipline from being distorted by the latest results. In the long run, plan following is what you can control. A routine works best when it fits your real life rather than an idealized version of it. If your schedule changes, the routine may need to shift in timing without losing its core structure. Missing one block does not automatically mean you are undisciplined. What matters more is whether the routine remains simple, repeatable, and realistic enough to maintain. It should also include time away from charts, because rest is part of decision quality. Consistency beats complexity, especially when life is busy. Natalie is a good example of process over emotion. She trades part-time, so instead of trying to monitor the market constantly, She builds her edge around selectivity and fixed rules. Each morning, she scans for only 2 patterns, checks alerts later in the day at 3 o'clock, and risks a fixed $200 per trade. Just as importantly, she gives herself credit when she follows the plan, even if a trade loses. That mindset keeps her focused on what she can control. Her success comes from discipline and structure, not from nonstop screen time. Strong routines are lean, stable, and realistic, so it helps to avoid a few common mistakes. Making the routine too long creates friction and makes it harder to repeat daily. Changing it too often prevents you from learning whether it actually works. Confusing routine with superstition can also distract you from the parts that affect performance. Skipping the shutdown step leaves the day mentally unfinished, and judging the routine by money alone can hide whether it is improving discipline. The best way to refine a routine is to test it consistently. Keep what helps and remove what does not.